ExamPrep.School. Indiana Life Insurance Laws and Regulations exam. There are 5 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Indiana laws and department rules common to all lines. Life regulations. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under Indiana law, an insurance producer is best defined as A. An individual who assesses and adjusts insurance claims on behalf of an insurer. B. An individual who binds coverage and issues policies without insurer approval. C. An individual required to be licensed to sell, solicit, or negotiate insurance. D. An individual who provides only legal advice regarding insurance policy language. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is C. This definition aligns exactly with the Indiana statute describing a producer as someone who sells, solicits, or negotiates insurance and must be licensed. Claims adjusters and attorneys are regulated under separate licenses and authorities. Reason A is not correct. Adjusting claims is the role of a claims adjuster, not an insurance producer. Reason B is not correct. Binding authority and policy issuance without insurer consent exceeds a producer's regulated activities. Reason D is not correct. Providing legal advice about policy terms is the function of an attorney, not a producer. Question 2. Which line of authority must an Indiana producer hold to sell variable annuity contracts? A. Personal lines. B. Life insurance. C. Variable life and variable annuity. D. Surplus lines. The correct answer is C. Indiana law specifies that producers must have the variable life and variable annuity authority to market or sell any variable annuity contracts, distinct from general life or personal lines licenses. Reason A is not correct. Personal lines authority is limited to property and casualty personal coverages, not variable annuities. Reason B is not correct. A general life insurance license does not cover securities-based variable annuity products. Reason D is not correct. Surplus lines authority permits placing risk with non-admitted insurers, not selling variable annuities. Question 3. After passing the licensing examination, a resident applicant in Indiana must submit the producer license application within how many days? A. 30 days. B. 60 days. C. 90 days. D. 180 days. The correct answer is C. Indiana regulations require that resident applicants who pass the exam file a completed license application within 90 days of the exam date. Failure to do so necessitates retaking the exam. Reason A is not correct. A 30-day period is too short. The statute specifies a 90-day window. Reason B is not correct. 60 days does not comply with the specified timeframe in Indiana law. Reason D is not correct. 180 days exceeds the maximum period allowed by regulation. Question 4. A non-resident producer from a reciprocal state must submit which document when applying for an Indiana non-resident license? A. Certificate of completion of Indiana per-license education. B. Criminal background report from Indiana State Police. C. Certified license history from the home state. D. Letter of character reference from a supervising producer. The correct answer is C. Indiana requires a certified license history from the producer's home state to verify that the non-resident license is in good standing before issuing its own non-resident license. Reason A is not correct. Pre-license education in Indiana is not required for non-residents from reciprocal states. Reason B is not correct. Criminal background reports are processed at initial resident application, not for non-resident reciprocity. Reason D is not correct. Character references are not a mandatory document for non-resident licensing. Question 5. Under Indiana law, a business entity must obtain a producer license when it A. Employs multiple resident producers under one roof. B. Processes premium billing statements for an insurer. C. Negotiates the terms of an insurance contract on behalf of clients. D. Manages claims adjustments for policyholders. The correct answer is C. Insurance statutes require any entity that negotiates, solicits, or sells insurance on behalf of clients to be licensed as a producer. Administrative and claims handling activities are not covered under the producer license. Reason A is not correct. Simply employing producers does not require the entity itself to hold a license. Reason B is not correct. Processing billing is an administrative function not requiring a producer license. Reason D is not correct. Claims adjustment is the function of a claims adjuster, not a producer licensee. Question 6. A business entity licensed as an insurance producer in Indiana must designate a responsible licensed producer who A. Holds each line of authority the entity holds. B. Is the sole owner of the entity. C. Maintains staff-level producer appointments. D. Has no ownership interest in the entity. The correct answer is A. Indiana rules require the designated producer to be licensed in every line of authority for which the business entity is licensed to ensure proper oversight and compliance. Reason B is not correct. Ownership alone does not satisfy the licensing requirement. Reason C is not correct. Staff-level appointments are not a substitute for full-line authority. Reason D is not correct. There is no prohibition on ownership interest for the designated producer. Question 7. Under Indiana law, a temporary producer license may be issued to which individual? A. A spouse of a deceased licensed producer. B. An individual awaiting exam results. C. A corporate partner of a suspended producer. D. An insurance claims investigator. The correct answer is A. Statutes allow issuance of a temporary license to a surviving spouse or personal representative to continue existing insurance business after a producer's death or disability. Reason B is not correct. Waiting for exam results does not qualify an individual for a temporary license. Reason C is not correct. Partners of suspended producers are not eligible for temporary licensing. Reason D is not correct. Claims investigators are not covered under temporary producer licensing provisions. Question 8. A producer applicant for an Indiana resident license previously had a life insurance producer license revoked by another state in June 2018 for record-keeping violations. In June 2024, the applicant submits her Indiana license application. Under Indiana law, what is the appropriate licensing determination? A. Deny because the revocation occurred in another jurisdiction. B. Defer action pending additional documentation of record-keeping compliance. C. Approve because the revocation was for non-fraudulent conduct. D. Approve because the revocation occurred more than 5 years ago. The correct answer is D. This option is correct because Indiana law permits licensure when a prior revocation took place more than 5 years ago. The 5-year period from the revocation date has elapsed. Reason A is not correct. This answer is incorrect because the revocation occurred over 5 years ago and is no longer a disqualifying action. Reason B is not correct. This answer is incorrect because additional documentation is unnecessary once the 5-year waiting period has passed. Reason C is not correct. This answer is incorrect because the nature of the revocation does not override the 5-year time requirement for denials. Question 9. In May 2024, an individual seeks an Indiana producer license. The applicant was convicted of insurance fraud in April 2016 and completed sentencing in December 2017. Which licensing action must the Indiana Department of Insurance take under state law? A. Defer until the applicant obtains a pardon for the conviction. B. Approve because sentencing was completed over 6 years ago. C. Deny because the fraud conviction occurred within the last 10 years. D. Approve because the conviction is nonviolent. The correct answer is C. This option is correct because Indiana law requires denial of licensure to any applicant convicted of insurance fraud within the past 10 years, and the conviction date falls within that period. Reason A is not correct. This answer is incorrect because a pardon is not required. The conviction itself within 10 years is sufficient grounds for denial. Reason B is not correct. This answer is incorrect because the completion of sentencing over 6 years ago does not affect the 10-year denial period for fraud convictions. Reason D is not correct. This answer is incorrect because the violent or nonviolent nature of the crime does not change the mandatory denial period for fraud convictions. Question 10. In June 2024, a new producer applicant in Indiana submits his license application and attempts to comply with fingerprint requirements by mailing ink fingerprint cards captured by a local law enforcement agency. Under Indiana law, which statement describes the department's fingerprint submission requirement? A. Pure comparative negligence. B. Accept ink fingerprint cards from any law enforcement agency. C. Waive the fingerprint requirement for non-resident applicants. D. Require electronic submission through a department-approved vendor. The correct answer is D. This option is correct because Indiana law mandates that applicants submit electronic fingerprints via a department-approved vendor for national and state criminal history checks. Ink cards are not accepted. Reason A is not correct. This answer is incorrect because fingerprints must be submitted close to the application date and not up to 1 year prior. Reason B is not correct. This answer is incorrect because only electronic submissions through an approved vendor are accepted, not ink cards. Reason C is not correct. This answer is incorrect because fingerprint requirements apply equally to resident and non-resident applicants. Question 11. Under Indiana insurance law, which action is an example of misrepresentation? A. Knowingly making a material false statement regarding a policy benefit. B. Quoting prospective dividends as guaranteed returns on a policy. C. Presenting an insurer's financial strength rating without clarification. D. Using an insurer's name in advertising without agent identification. The correct answer is A. The correct answer is knowingly making a material false statement regarding a policy benefit, which directly matches the statutory definition of misrepresentation under Indiana law. Reason B is not correct. Quoting prospective dividends as guaranteed returns is a prohibited misleading guarantee, but is categorized separately from misrepresentation. Reason C is not correct. Presenting a financial strength rating without clarification may be incomplete disclosure but does not constitute misrepresentation. Reason D is not correct. Using an insurer's name without agent identification violates identification rules but is not classified as a misrepresentation. Question 12. Under Indiana insurance regulations, twisting involves which of the following? A. Willfully misrepresenting a policy to induce replacement of existing coverage. B. Assisting in the compliant transfer of cash values during policy replacement. C. Recommending changes based on financial objectives without misrepresentation. D. Offering non-commissioned incentives to purchase an additional policy. The correct answer is A. The correct answer is willfully misrepresenting a policy to induce replacement of existing coverage, which aligns with the statutory definition of twisting under Indiana law. Reason B is not correct. Assisting in a compliant transfer of cash values follows replacement regulations and is not twisting. Reason C is not correct. Recommending changes based on objectives without misrepresentation is permitted advisory service. Reason D is not correct. Offering non-commissioned incentives is a rebating issue, not twisting. Question 13. Under Indiana law, rebating is best described as which of the following? A. Returning a portion of the agent's commission to the policyholder. B. Providing policyholders with educational materials at no charge. C. Applying a discount to the premium based on good payment history. D. Granting lower rates solely to applicants with a favorable occupation. The correct answer is A. The correct answer is returning a portion of the agent's commission to the policyholder, which constitutes a prohibited inducement under Indiana's rebating statutes. Reason B is not correct. Providing educational materials is allowed informational assistance, not a rebate. Reason C is not correct. Discounts for payment history are underwriting adjustments, not rebating. Reason D is not correct. Occupation-based rate setting is risk classification, not a rebate. Question 14. Under Indiana law, which practice in underwriting would constitute illegal discrimination? A. Charging higher premiums based solely on an applicant's race. B. Adjusting rates according to an applicant's hazardous occupation. C. Rating policies based on an insured's prior claims history. D. Requiring applicants to complete a medical examination. The correct answer is A. The correct answer is charging higher premiums solely on an applicant's race, which violates Indiana's prohibition on discrimination by race in underwriting. Reason B is not correct. Adjusting rates for hazardous occupations is a permitted risk-based classification. Reason C is not correct. Using prior claims history and rating is allowed actuarial practice. Reason D is not correct. Medical examinations are an accepted underwriting tool when properly applied. Question 15. Under Indiana insurance law, which statement by an agent constitutes defamation of an insurer? A. Claiming an insurer is insolvent and will not pay claims without evidence. B. Citing a competitor's public rating report in a sales presentation. C. Accurately comparing two insurers' financial ratings from a reliable source. D. Explaining coverage differences between insurers using official disclosures. The correct answer is A. The correct answer is claiming an insurer is insolvent without evidence, which is a false statement that harms the insurer's reputation and qualifies as defamation under Indiana law. Reason B is not correct. Citing a public rating report is factual and not defamatory. Reason C is not correct. Accurately comparing financial ratings from reliable sources is permitted marketing. Reason D is not correct. Using official disclosures to explain coverage differences is lawful and non-defamatory. Question 16. An Indiana agent advertises a life insurance policy as offering lifetime guaranteed level premiums in all promotional materials, but does not disclose that the guarantee applies only if the policy's cash value remains above a specified threshold. Under Indiana law, which practice best illustrates false advertising? A. Omitting a material limitation of the advertised guarantee. B. Exaggerating policy benefits beyond authorized provisions. C. Failing to mention the insurer's current financial strength rating. D. Using customer testimonials as endorsements without insurer approval. The correct answer is A. The correct answer is omitting a material limitation because Indiana law defines false advertising as any untrue, deceptive, or misleading statement, or omission of material fact about insurance products. Reason B is not correct. This option refers to puffery rather than a prohibited omission of material facts. Reason C is not correct. Insurer rating disclosures are governed by separate rules and not the central element of false advertising here. Reason D is not correct. Use of testimonials without approval relates to advertising form requirements, not omission of material policy limitations. Question 17. An insurer notifies its appointed producers that representing any competing insurer will result in immediate contract termination. A producer who declines to remove competing agencies from their portfolio faces loss of commissions. Which unfair trade practice does this conduct exemplify under Indiana law? A. Rebating inducements to policyholders. B. Boycott, coercion, or intimidation. C. Unfair discrimination based on policyholder characteristics. D. Misrepresentation of policy terms. The correct answer is B. The correct answer is boycott, coercion, or intimidation, because threatening producers with termination for representing competitors is prohibited under Indiana statutes. Reason A is not correct. Rebating refers to offering prohibited inducements to insureds, not threats against producers. Reason C is not correct. Unfair discrimination addresses differential treatment of insureds, not restriction of producer affiliations. Reason D is not correct. Misrepresentation involves false policy statements, not producer intimidation. Question 18. Which of the following is a power granted to the Indiana Insurance Commissioner under state law for enforcing insurance regulations? A. Subpoena witnesses and compel the production of documents during investigations. B. Set premium rates for all insurance companies operating in Indiana. C. Determine insolvency and liquidate unaffiliated domestic insurers. D. Enact legislation to amend the Indiana Insurance Code. The correct answer is A. This option correctly describes the authority to issue subpoenas and compel document production as part of enforcement activities. Reason B is not correct. Setting premium rates is typically the role of the insurance market and rate review process, not a direct enforcement power. Reason C is not correct. Determining insolvency and liquidating insurers is handled through the courts and the receivership process, not solely by the commissioner. Reason D is not correct. Enacting legislation falls under the state legislature's authority, not the commissioner's rulemaking powers. Question 19. Under Indiana insurance law, how often must the Department of Insurance conduct a financial examination of each domestic insurer? A. Every year. B. Every 3 years. C. Every 5 years. D. Every 10 years. The correct answer is C. Indiana law mandates that each domestic insurer be examined at least once every 5 years to ensure financial solvency and compliance. Reason A is not correct. Annual examinations are not required for every domestic insurer unless triggered by other factors. Reason B is not correct. Examinations every 3 years exceed the statutory minimum frequency. Reason D is not correct. A 10-year interval would delay crucial oversight beyond the statutory requirement. Question 20. Which of the following situations would most likely trigger a market conduct examination by the Indiana Department of Insurance? A. An insurer reports a significant increase in its underwriting profit over 2 consecutive years. B. An insurer requests an extension for filing its annual financial statement. C. An insurer voluntarily reduces its premium rates below the minimum filed rates. D. An insurer has a substantially higher ratio of consumer complaints compared to its peers. The correct answer is D. A high ratio of consumer complaints is a primary indicator prompting a market conduct examination to assess unfair trade or claims practices. Reason A is not correct. Higher profits alone do not indicate misconduct or consumer harm. Reason B is not correct. Filing extensions relate to financial reporting, not market conduct investigations. Reason C is not correct. Voluntarily lowering rates is not a standard trigger for market conduct review. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.